Good evening, everyone. Quite a panic day for the Indian equity markets today. Not the best of situations to face if you're a newbie in the financial domain and aspire yourself to be a successful trader in the future. But nevertheless, these kind of days are the best from a learning point of view as they are rare. So I just thought I'll share my views about how the market panned out today and what are the possibilities and what are the levels and how to read the market for the immediate future to come. So we're a 6% cut in the benchmark Nifty today, close to 500 points on a close to close basis. A big gap up, a big gap down, beg your pardon, followed by follow through selling, closing at the very close near the low of the day with decently high cash market volumes, all add up to be quite a significant negative close, negative sentiment based close for the overall markets. This signifies a high possibility that the market can probably inch further down. A little bit of market summary. Amongst the top traded stocks, we have losing stocks across the board, with ITC at the end of the spectrum, down just a little tad below the 3% mark. With stocks like ONGC, which cracked over 10% to close at 228. It was essentially bloodbath across the board. If we look at the all-time low stocks and in terms of sort them in terms of value, we find names like DLF, which has gone back to its life lows. JP Associates is one that's been doing such thing quite often nowadays. GMR Infra, Adani Power, few power stocks are also lined up in this list. Stocks which are bleeding and still at their life lows. Amongst the Nifty 50, because when you have these kind of falls in the overall markets, valuation players or traders who are purely contrarian in nature would love to catch a falling knife and would actually first look into the high quality large cap blue chip names. So if I look into the sectors, saw them in terms of the losing sectors, obviously the reality tops the list. The mid caps bled really bad, with the Nifty mid cap index down over 10%. The small caps and the PSU banks also were really beaten down. And at the other end of the spectrum, if it was the FMCG, we saw some time back that it was ITC which was holding it, but still nonetheless down close to 4% for the day. IT, apparently the pocket of strength, but still it was down close to 5%. Net, as I said, a rare day where you see selling across the board. Index pullers and draggers, ICICI Bank actually dragged the market the maximum, keeping in mind the kind of weightage it has. Looking into the slightly weekly charts, we see that the bank has been in a downtrend for quite some time. Apart from ICICI Bank, there were names like Reliance. This is an interesting chart to keep a watch. Big gap down of consecutive 2 days. The stock is back to levels that it was seeing in the March 2015. So the entire year's effort has gone into vain and back to that early 2015 levels. The list keeps on going on with Infosys, HDFC, L&T and HDFC Bank, Axis Bank. I would bring your focus in few banking stocks like an Yes Bank, which was actually beaten off quite sharply back to those gaps. Again, moving back to the weekly charts will show you very clearly where the distribution for Yes Bank was. So having said that, what should we do now? Where should we keep our focus on? One thing that I would like to share with you, especially when I faced the sell-off of 2008, 2009, was to keep in mind that when you have such rare instances of big gap downs, follow through selling, it's always important to understand that the market is behaving itself from a slightly longer time frame. So you need to step back of the daily time frame and have a look at the weekly or the monthly charts. Now this is the weekly chart of Nifty Spot, and if we see that the kind of rally that we had from late 2011 all the way, that was the levels of around 4,500, we had a pretty decent bull market, kind of a higher highs, higher lows. In between we had our share of small sell-offs, but the primary trend seemed to be fairly up till we hit 9k a few months back. So a simple fib retracement will show you that the erstwhile close to that 8k mark suppose was close to the 23.6% retracement, Fibonacci retracement of this entire low to high move. And with this fall that we have for the day, these levels have been decidedly taken out. We've closed below that, and the next level would be close to that 38.2%, which is close to 73.66. So let's say around 73.74. If I come down here, I see that in the month of July we have a low which was close to the 74.22 mark. So 73.74 kind of levels is where, in terms of fib, we're getting some kind of support. Now if I move one step back further from weekly, if I just open the monthly charts, this is few things that I would like to share with you. This is the entire history of the NSE Nifty on the monthly scale. And if you see the blue line, which has been holding the previous bull market and the bear market and has inched further to hit new highs, are holding quite a few bars, are actually touching quite a few important lows. And close to these levels, very unlikely, the levels in the August comes to around 71, 72. So in this support from this very important trend line also comes around close to that 7200, 7250 mark. From our weekly, we found that 73, 74. From a monthly trend line, we're getting around 72. So that's the band when the markets react so bad, so sharp. A 50-point, 100-point buffer, some room for going further down needs to be taken. So let's say we just take our levels down to 72, 74 now. The worst case scenario. Okay, now the worst case scenario, the way I am looking into it right now is, I don't know when it will come, if it at all comes. I wish it doesn't. But generally, if I look into how my previous bull market started, I go back and check how the May 2005 was. The market had pretty decent resistances in the range of 1800 to 2K. Came close to that, held for 3-4 months, and then it took off for the highs of 2008. And then we know what kind of a 56-57% odd sell-off bear market we had in 2009. Now, when in October it made a panic low, it actually came close to test its erstwhile trend line. Now, these trend lines were giving resistance, and they come back after years to find support. This is not a very rare thing to find, because we tend to see that trend lines, once broken, changes their behavior quite well. So if I'm expecting something like that this time, and this was a similar kind of trend line which was holding the highs, and we had a pretty good breakout from the 64, 65 kind of range, one-way move up, and if the market is eyeing a seriously big correction at this stage, then the next level on the downside, or I would say the worst case scenario, where this entire bull market story dissolves itself, is that 64, 65 range. So keep these levels in mind. Mind you, we are looking into the weekly and monthly charts, so we're talking of levels which are quite distant from where we are trading right now. So the first level comes from our weekly fib and the monthly charts, which tells us that if this extends further down sharply, then between 72 and 74 one can actually look to accumulate. And the worst case scenario, where there is a threat to the bull market that we have in our hands, is close to that 64, 65 range. Simple trend line, guys, but they tend to work fairly well. If you look at your indicators in any time frame, they are inching down, be it the stochastics or the MACDs or the RSIs. They will be oversold. They will stay oversold till you get any sign of any positive divergence shaping up. So net, keeping in mind the close that we have in our hands, keeping in mind that the US market futures are still down over 300-400 points. That's the Dow Jones futures. I sense that we probably have some further room down. Try to do contrarian trades if at all you're quite confident with some divergence in your hands in the stocks, but keep a very close watch on the weekly and the monthly levels that we just discussed. Trade well, trade wise, guys. Bye.